They say liquidity disappears loudly. After the headlines break, after volatility surges, after traders flood the screens trying to unwind positions they never should have taken. But those who've been around long enough know the truth runs the other way. Liquidity doesn't vanish in chaos, it thins in silence. It drains not when markets panic, but when they still look calm on the surface, when spreads seem orderly, when the screens glow with the illusion of depth. If you watch the repo market in those quiet hours, when only the machines hum and the terminals cast their cold light onto empty desks, you can feel the shift. A dealer hesitates to quote size. A counterparty rolls less than they did yesterday. A collateral schedule adjusts by a single line, buried deep inside a footnote no journalist ever reads. Nothing dramatic. Nothing anyone outside the system would ever notice. Yet for those who live inside this plumbing, it's the kind of movement that makes you sit up straight, not because something broke, but because something decided not to stretch as far as it used to. In the collateral underworld, stress doesn't announce itself. It whispers. And before anyone else senses danger, the whisper becomes a rule. Protect your balance sheet first, provide liquidity second. If you've ever stared at a repo book moments before the market opens, you know the sensation, an uneasy stillness that doesn't fit the data await in the room that suggests something behind the scenes has shifted, even though every chart still looks fine. There is a reason insiders call it the thin hour. It's the moment when the most important market in global finance begins revealing what it truly feels underneath the surface. Not the part analysts talk about. Not the part policymakers pretend to control. The real part, the part where collateral moves like blood through the veins of the system. And any hesitation, any slowdown, any thinning signals more than just a temporary imbalance. It signals that someone somewhere is preparing for pressure the public hasn't felt yet. Let's take a step back. What are we even talking about? The repo, or repurchase agreement market, is the essential, yet invisible, engine of the global financial system. Think of it as a giant, sophisticated pawn shop. Financial institutions with cash lend it to other institutions that need it, and in return, they receive high-quality collateral, typically government bonds like U.S. Treasuries. The next day, the borrower buys back their bonds, paying a little bit of interest. This overnight lending happens trillions of dollars at a time, every single day. It's what allows banks to manage their daily cash needs, what lets hedge funds finance their trades, and what keeps the entire system humming smoothly. When it works, you never hear about it. But when it doesn't, everything else starts to break. The key here is the collateral, the U.S. Treasury bond. It's considered the safest asset on the planet, the bedrock of finance. But what happens when there's a subtle change in how the market values that bedrock? That's where the quiet thinning begins. The dangerous part isn't the thinning itself. It's that the thinning is always rational. Someone, somewhere, sees something, feels something, or measures something you won't see in the headlines for another month. Maybe it's a shortage of a specific type of treasury bond, like a particular maturity. Maybe it has pressure on a dealer as balance sheet that forces them to step back and lend less. Maybe an unexpected change in treasury issuance tilts the mix of collateral quality just enough to tighten conditions. Or maybe, and this is the most quietly dangerous of all, it's the growing awareness that the very same treasury bond has been reused or rehypothecated one layer too many in a long chain of transactions that no single regulator can fully monitor. Picture a single treasury bond. Bank A lends it to hedge fund B, which then posts it as collateral to prime broker C, who then lends it to money market fund D. This is a collateral chain. Each link in the chain represents a transaction that relies on the integrity of that original bond. These chains can get incredibly long and complex. But what if Bank A suddenly needs its bond back? Or what if prime broker C decides it's taking on too much risk and doesn't want to lend against that bond anymore? The chain snaps. And the longer the chain, the more violent the snap. Now imagine this isn't just one chain, but thousands of them, all getting a little more fragile at the same time. This is the source of the whisper. No one has defaulted. No one has gone bust. But the big players are quietly shortening their chains, refusing to accept certain types of collateral, or simply hoarding the best stuff for themselves. They are preparing for a storm they won't talk about. This brings us back to the thin hour. Before the stock market even opens, the repo market is already alive. Dealers are setting their rates. Institutions are lining up their funding for the day. And in those critical moments, you can feel it. A dealer who used to offer $1 billion in funding is now only offering half that. A rate that was once stable starts to flicker. A counterparty who always accepted a wide range of collateral now only wants the most pristine, on-the-run Treasury bills. None of these are headline-grabbing events. They are subtle adjustments made by rational actors protecting their own interests. But when you add them all up, they represent a collective retreat from risk. The market is getting thinner. The pool of available liquidity is shrinking, not with a bang, but with a quiet collective sigh of caution. Think about the repo crisis of September 2019. Before the rate spiked to an insane 10%, before the Federal Reserve had to intervene with hundreds of billions of dollars, the whispers were there. Insiders saw dealers stepping back. They saw the supply and demand for reserves getting out of balance. The plumbing of the system was getting clogged, but on the surface, for most people, everything looked fine. The stock market was near all-time highs. Then, all at once, the system seized. The loud part, the part everyone saw, was the rate spike. But the real story, the one that mattered, had been unfolding silently for weeks in the thinning liquidity of the repo market. The system had already spent weeks whispering its warning, but very few were listening. And that is why the story matters today more than ever. Because by the time the public finally sees volatility, by the time CNBC is flashing red arrows and experts are talking about a flight to safety, the system has already made its move. The cracks are never visible at first. They begin where liquidity is supposed to be deepest, in the heart of the system, the market for U.S. government debt. The silent withdrawal of a few key lenders, the subtle shift in collateral preference, these are not just footnotes for financial nerds. They are the first tremors of an earthquake that hasn't hit yet. It's the first signal that the people with the most at stake, the ones who manage the core of the financial system, no longer believe the story that everything is fine. So, when you hear that liquidity vanished loudly, remember that it's only the final chapter. The real story begins in the quiet moments, in the thin hour of the repo market. It's a story told not in headlines, but in the hesitation of a dealer, in the shortening of a collateral chain, in a silent retreat from risk that happens long before the panic starts. And if you follow this story until the end, you will see why the thinnest moment in repo isn't just an obscure market signal. It's the first warning that no one believes until it is far too late. After 2008, the world economy teetered on the brink. Policymakers swooped in, promising to fix the broken financial system. They gave us new rules, new regulations, designed to prevent another meltdown. But what if I told you that in fixing one problem, they accidentally created a new, quieter, and perhaps even more dangerous one? This isn't a conspiracy theory. This is the hidden story of the global financial system's plumbing and how it's slowly, silently becoming dangerously thin. After the crisis, the big reform was called Basel III. It was a set of rules for banks, and its goals were noble. It forced banks to be stronger, to hold more stable capital, and to rely less on risky, short-term borrowing. It also made them take a hard look at all the complex financial instruments they were juggling off their main books. On the surface, this all sounds great, right? Stronger banks mean a safer system. But here's the unintended consequence, the twist in the story that few people talk about. These new rules had a devastating effect on a critical, yet invisible, part of the financial world, the repo market. Think of the repo market as the ultimate pawnshop for financial institutions. Banks and funds go there to get overnight cash using ultra-safe assets like U.S. Treasury bonds as collateral. It's the grease that keeps the entire financial engine running smoothly. But Basel III made it much more expensive for big banks to participate in this market. Their balance sheets had less room. They had less appetite for holding the inventory of Treasury bonds needed to make the market work. And crucially, they became much less willing to lend into this market, especially when things got a little shaky. At the exact same time, demand for those very same Treasury bonds was exploding. Everyone wanted them. Foreign governments, massive pension funds, insurance companies, money market funds, and hedge funds were all scrambling to own the safest asset in the world. So you have this bizarre situation. A skyrocketing demand for treasuries, but the very banks that traditionally helped move them around the system were being forced to step back. The system became more and more dependent on every single new bond the U.S. government issued. The market, which the world needed to be deep and robust, was silently thinning out. For years, this was a problem brewing beneath the surface, visible only to a few hardcore market insiders. Then came September 2019. Suddenly, this quiet mechanical problem burst onto the front pages. In the repo market, where interest rates are normally stable and boring, they suddenly spiked to nearly 10%. This was a five-alarm fire in what's supposed to be the safest, most predictable funding market on the planet. The newspapers and TV analysts offered simple explanations. They blamed corporate tax payment deadlines or technical settlement issues. Some pointed fingers at the Federal Reserve, which had been gradually shrinking its own balance sheet. But the insiders knew the real, terrifying truth. The system had become so fragile, so thin, that even a tiny bit of friction could cause a massive explosion. The big dealer banks were constrained by the new rules. The institutions with cash were hesitant to lend it. The intricate chains of collateral, where one bond is used as collateral for multiple loans, had become brittle and were at risk of shattering. The Fed had to jump in, pumping tens of billions of dollars into the market every single day just to calm things down. It was a stark warning, a glimpse into a reality that regulators didn't want to publicly admit. The vital plumbing of the financial system had evolved beyond their control. And then, just a few months later, 2020 arrived. The global pandemic didn't cause the crisis in the Treasury market. It just ripped the bandage off and exposed the wound that was already there. As fear gripped the world, everyone did the same thing. They sold everything to get their hands on cash. And paradoxically, that included selling used treasuries. Not because they thought the U.S. government would default, but because they needed the liquidity. But here's the problem. The dealers who are supposed to buy when everyone else is selling were already strained from the 2019 episode. They couldn't handle the flood. The result was chaos in the one market that's supposed to be the bedrock of global finance. The gap between buying and selling prices for Treasury bonds assets that are supposed to be as good as cash blew out to levels you'd expect to see in a volatile, emerging market. The repo market groaned under the pressure. The entire Treasury market, the foundation upon which everything else is built, seized up. It had become so choked with hidden leverage and was so thinly supported that it simply broke. The Federal Reserve's response was monumental. They unleashed a torrent of money through quantitative easing, opened up swap lines to other central banks, and created backstops for nearly every corner of the market. But make no mistake, these weren't just measures to stimulate the economy. These were acts of emergency structural preservation. They were patching up the pipes to prevent the entire house from flooding. The system had reached a point where it could no longer function without a constant drip of life support from the central bank. Markets eventually calmed down, but the underlying problem, the silent thinning, never went away. It just changed its shape. The U.S. government, funding its massive pandemic response, issued trillions in new debt. Foreign central banks tinkered with how they held their reserves. And trillions of dollars from money market funds, having nowhere else to go, ended up parked at the Fed itself in a facility called the reverse repo. Meanwhile, the chains of collateral became even more opaque, a shifting, hidden map of risk that no one, not even the regulators, could fully see. And so, despite all the reforms, despite all the promises made after 2008, a fundamental and dangerous truth remained. The stability of the entire global financial system depends on a market whose true depth is far, far thinner than anyone is willing to admit publicly. This brings us to today. This whole history lesson isn't just about the past. It's the essential context for a warning that is once again being ignored. The thinning of this vital market liquidity has never been a random event. It's never been a sudden shock out of the blue. It has always been the slow, quiet, predictable result of decades of structural changes, regulatory decisions, and the buildup of hidden leverage. Every time this fragility has led to a crisis, the market itself was sending out signals long before the headlines caught on. The story was there for those who knew how to read it. And right now, that same story is beginning to surface again. The question is, are we paying attention this time? Or are we going to wait for the next explosion to realize the plumbing has failed again? We often hear about the repo market only when something breaks. It sounds like some obscure, complicated part of finance that just randomly malfunctions. But the truth is, the repo market has been sending us warning signals for decades, long before the 2019 repo spike or the 2008 financial crisis. These aren't signs of sudden panic. They're clues left behind by quiet structural decisions that made the system incredibly fragile. To understand how we got here, we have to go back in time, way back to the 1980s. Back then, the U.S. Treasury market was a much simpler place. A group of big banks called primary dealers bought government bonds and financed them using simple repurchase agreements or repos. They de-sell a bond to an investor overnight and promise to buy it back the next day for a slightly higher price. It was a straightforward, low-risk way to get short-term cash. But then, an idea emerged that seemed like a brilliant innovation. What if you could reuse that same Treasury bond? The person who bought it in the repo transaction could then use it as collateral for their own loan. This is called rehypothecation. It seemed like a win-win. It greased the wheels of finance, lowered borrowing costs, and created more liquidity without needing more government debt. Banks loved it, regulators didn't object, and Wall Street, always hungry for more leverage, started building a massive financial architecture on top of this concept. The problem is, innovations like this don't stay small. They grow, they multiply, and they get complicated. By the 1990s, rehypothecation had transformed the repo market from a stable funding source into a sprawling, interconnected web. The same single Treasury bond could now be underpinning 3, 4, or even 5 different loans at the same time, creating what are known as collateral chains. This was the first time liquidity started to thin out, not because of a crisis, but because the market had become dangerously efficient. It was a silent thinning, happening behind the scenes, creating hidden dependencies that no one was fully tracking. The first major crack in this system appeared in 1998 with the collapse of a hedge fund called Long-Term Capital Management, or LTCM. Most people remember LTCM for its massive leverage and complex derivatives bets. But the real story, the one insiders know, was about repo. LTCM's entire strategy depended on the assumption that it could always get cheap, easy financing using Treasury collateral. But when the market suddenly got nervous, that assumption fell apart. Liquidity vanished overnight. The dealers who had been lending to LTCM got scared and pulled back. They demanded more collateral for every dollar they lent, a process called increasing haircuts. The intricate chains of reused collateral tightened instantly, sending shockwaves through the system. The Federal Reserve had to orchestrate a massive bailout, not just to save one hedge fund, but to save the perception that the repo market was uncheckable. If that perception had shattered, the entire foundation of modern finance, built on the magic of reusable collateral, would have been called into question. After LTCM, regulators started talking more about liquidity risk. But they never tackled the root cause, the fact that Treasury collateral had become the central pillar of global finance, and its reuse had created a system so complex that no one could map its connections or vulnerabilities. The system's complexity had become its greatest weakness. And then came 2008. We all remember the stories of subprime mortgages, credit default swaps, and the spectacular failures of Bear Stearns and Lehman Brothers. But underneath all that drama, the repo market had been slowly seizing up for months. It was another silent crisis, hidden from public view. As the value of mortgage-backed securities plummeted, everyone scrambled for the safety of U.S. Treasuries. But there was a huge problem. The Treasury market wasn't just a safe haven anymore. It was the foundation for trillions of dollars in synthetic liquidity created through those long, tangled rehypothecation chains. When dealers stopped accepting mortgage bonds as collateral, the sudden rush into treasuries was so violent that it broke the system in a new way. Lenders started demanding higher haircuts even on ultra-safe treasury bonds. This was something that economic models said should never happen. Treasuries were supposed to be the ultimate safe asset, the escape route in a crisis, not another source of stress. The 2008 crisis revealed a terrifying truth. The quality of your collateral, whether it's a mortgage bond or a treasury, matters far less than the behavior of the collateral system itself. And decades of silent leverage and rehypothecation had distorted that behavior beyond recognition. The system didn't just crash because of bad loans. It trembled because the reuse of good collateral had reached a breaking point. Liquidity no longer meant there was a lot of cash available. It meant the entire system was dependent on a fragile, invisible web of promises. The Fed stepped in with unprecedented programs to pump liquidity back into the market, but these were emergency patches, not a permanent fix. They addressed the symptoms, but the underlying disease, our dependence on infinite collateral reuse, remained. The real twist, the moment the game truly changes, happens in the shadows of the financial system in a place most people have never heard of, the repo market. And it doesn't start with a crisis. It starts when the safest asset in the world, a U.S. Treasury note, starts acting like it has a secret. Imagine this. A Treasury note, identical on paper to every other one, suddenly stops flowing through the system with the same old ease. Nothing has officially changed. The government hasn't missed a payment. The credit rating is still perfect. But somewhere deep in the plumbing of finance, a dealer makes a tiny adjustment. Maybe they tighten a collateral schedule or they adjust a haircut, the small discount they apply to the collateral's value. Or maybe, just maybe, they hesitate for a split second before rolling over a position that for years has been completely automatic. This is the first tremor. It's a shift so subtle you can't see it, but you can feel it if you know where to look. It feels like a thinning of offers in the market. It feels like an unexplainable stiffness in how banks use their balance sheets. Suddenly, the risk-free asset isn't behaving in a risk-free way. That's the moment the insiders, the traders and the dealers, realize they've crossed into uncharted territory, a place no financial model has ever mapped out. The public never sees this happen. There are no fireworks, no emergency meetings. It arrives as an absence. The absence of depth in the market. The absence of dealers stepping in to provide liquidity like they always have. The absence of that assumed elasticity, the system's ability to stretch and absorb pressure. On the surface, everything looks normal. But underneath, a fundamental gear has shifted. When liquidity starts to thin out in the repo market, it's not because people have stopped wanting to borrow. It's because the people with the cash have stopped being willing to lend it as freely. The dealers, the giant banks that act as the silent lungs of the financial system, suddenly start protecting themselves first. Their balance sheets are already weighed down by regulations and internal risk limits. They just don't have the extra capacity anymore to handle collateral that has been passed around too many times, through chains that have become too long, too complex, and too fragile. What used to be a simple, boring exchange, I give you cash, you give me this Treasury note as collateral, now carries a silent, unspoken question. Who else has used this exact same Treasury note as collateral, and how many times has it been promised to someone else? That question is the pivot. It's the signal that collateral is no longer being trusted just because it is a government bond. It's being judged by its behavior, how fast it's moving, how many times it's been reused, and what kind of hidden leverage it's supporting. And once that seed of doubt is planted in the system, it never fully goes away. The twist becomes undeniable when a specific Treasury bond, say, one that matures in 2 years, starts trading special. This doesn't mean it's special because everyone wants it. It means it's become special because the system can't function without it. That one specific bond has become the linchpin for dozens of different transactions, a crucial piece in multiple collateral chains. If it gets reused just one too many times, invisible stress builds up. If a single bank in that chain hesitates to pass it along, the entire chain seizes up. And when the chain seizes up, repo liquidity doesn't vanish in a dramatic crash. It thins out through thousands of tiny, cumulative hesitations across trading desks all over the world. A dealer who once rolled over $1 billion position without a second thought now waits a few minutes just to be safe. A hedge fund that used to borrow for a month at a time now only asks for overnight financing. A money market fund that once accepted a wide range of bonds as collateral quietly narrows its criteria by a tiny fraction, a fraction that seems irrelevant, but isn't. These are the micro signals. These are the hairline cracks that appear in the foundation long before anyone sees the building start to tilt. But here's the most important part. This isn't about fear. The dealers aren't panicking. This is about knowledge. It's about the real-time information that regulators, rating agencies, and financial journalists simply don't have. Dealers see the behavior of collateral up close. They see how often a specific bond identified by its CUSIP number is traded. They see how frequently it returns to the same hands. They see how deeply it has penetrated the hidden chains of reuse and rehypothecation. When they start pulling back and protecting their own balance sheets, it's not an emotional reaction. It's a rational one. They are acting on data that tells them the system's margin for error has completely evaporated. This is the part that is so often misunderstood. Repo crises are never triggered by panic. They are triggered by the rational survival instincts of the system's most important players long before the panic ever sets in. The panic is a symptom, not the cause. And what happens next is even more unsettling. As soon as these small hesitations appear, the system begins to silently reorganize itself. Collateral that once moved freely around the entire market starts to get hoarded, clustering in the hands of the biggest, most powerful players. The major banks start prioritizing their most important clients, the ones they absolutely cannot afford to lose. And the smaller players? The secondary borrowers, the hedge funds, the firms that depend on lower-tier access to financing? Their channels start to narrow. Liquidity doesn't just dry up. It stratifies. It becomes a tiered system. It's plentiful for those at the very top of the food chain, but for everyone else, it gets thinner and more expensive. They experience it as a subtle tightening of financial conditions, a quiet decrease in their access to funding, a strange and unexplained increase in the cost of doing business. This stratification is the real turning point. It has the moment when liquidity stops being a public good available to the entire market and becomes a privilege, allocated by the few institutions with the balance sheet capacity to grant it. By the time the public sees anything, a spike in interest rates, a talking head on TV warning of stresses in the funding markets, the real event is already over. The twist has already played out. The system has already shifted into a state of self-preservation. The thinning of liquidity wasn't the warning sign of the crisis. It was the crisis. It just happened in a way that was only visible to those who were watching the signals that never, ever make it into the headlines. The Bank for International Settlements found that the reuse of U.S. Treasuries could top $1 trillion a year. On any given day, the biggest dealers are financing hundreds of billions of dollars in treasuries, with total daily market flows sometimes exceeding $4 trillion. But here's the hidden part. A single treasury bond isn't just used once. In calm markets, $100 million of bonds might be used to back $300 million or more in loans. This is the reuse multiplier. It's like financial magic, creating liquidity out of thin air. But when stress hits, that magic vanishes. If just one link in that chain decides not to roll over their loan, the system doesn't lose $100 million in collateral. It loses the full $300 million in financing that everyone assumed was there. This is the invisible thinning, the quiet disappearance of liquidity that no one sees until it has too late. After the 2008 financial crisis, new rules like Basel III were designed to make banks safer. Banks were told to hold more high-quality assets and to limit how much they could borrow relative to their capital. One rule, the supplementary leverage ratio, or SLR, had an unintended side effect. It penalized banks for the sheer size of their balance sheets, regardless of how safe the assets were. Holding ultra-safe treasuries suddenly became costly because they took up valuable balance sheet space. So banks became pickier. They started quietly trimming their exposure. An internal risk committee at a major bank might decide to reduce its financing for a specific type of treasury by just 5%. Sounds tiny, right? But remember those rehypothecation chains? That 5% cut could ripple through the system and shrink the effective collateral supply by 15% or more. And when all the big banks start doing this at the same time, a series of small, private decisions creates a huge, systemic contraction. The thinning doesn't start with a panic. It starts in a conference room. The type of debt the U.S. government issues also plays a huge role. Think of short-term treasury bills as the oil that lubricates the financial engine. They're easy to price, easy to trade, and perfect for reuse. But sometimes, the government shifts to issuing more long-term bonds or coupons. These are more like thick grease. They're less liquid and harder for dealers to handle. So, when the market is flooded with these coupons, it might seem like there's more collateral, but it's the wrong kind. It's not the fast-moving stuff the system needs. At the same time, a huge chunk of treasuries gets locked away. Foreign governments and central banks buy trillions of dollars of U.S. debt and just hold on to it, effectively taking it out of circulation. Between 2010 and 2023, these holdings often exceeded $4 trillion. So you have a flood of less useful collateral coming in while the most useful collateral is being squirreled away. This puts immense pressure on the small pool of high-quality bonds that are left to do all the heavy lifting in the repo market. Now, let's add another piece to this puzzle: money market funds. These funds have trillions of dollars in cash, and for a while, they found a very attractive place to park it. The Federal Reserve's Overnight Reverse Repo Facility, or ONRRP. At its peak, over $2 trillion was sitting there. Instead of lending that cash into the private repo market where it could support those collateral chains, the money was effectively sterilized, taken out of the system. It was like closing half the lanes on our financial highway. We had plenty of cars, the treasuries, but not enough road space to move them around. The plumbing of the financial system got tighter and tighter, not because of a shortage of collateral, but because of a shortage of balance sheet capacity to recycle it. All these forces, regulation, issuance patterns, and money market behavior converge to create a system that's incredibly fragile. Repo liquidity doesn't thin because people panic. It thins because the structure itself becomes too rigid to support the constant reuse that markets have come to depend on. Let's walk through how a chain breaks in real time. In a normal market, a hedge fund gives a treasury to its prime broker. The prime broker reuses it in a repo deal with a big bank. That bank might reuse it again in another transaction. That $150 million bond is now supporting maybe $120 million in financing. It works perfectly as long as everyone keeps playing along. But then, one of those dealers, maybe their risk model flashes a warning, or their funding costs tick up, decides not to renew one of those deals. The chain doesn't just shrink, it shatters. A $50 million withdrawal of collateral can instantly vaporize $150 million in system-wide financing capacity simply because the reuse stops. This is the silent crash. It's not on the news and the public has no idea it's happening. But insiders watch it obsessively because it's the first tremor before the earthquake. And this contraction is never fair. It always cascades from the bottom up. The smallest hedge funds lose their financing first. The lower-tier dealers find themselves cut off before the giants at the top. The stress map of the financial system appears in reverse order of size and influence. One of the clearest examples of this dynamic occurred in March 2020. The world was panicking, and so was the market for U.S. Treasuries, the safest asset on earth. Suddenly, the cost to buy or sell them skyrocketed. Market depth, which is like the amount of securities available to trade, collapsed by over 60% in just a few days. On the surface, it looked like chaos. But the real problem had been brewing quietly for weeks. The big banks, known as primary dealers, were supposed to be the market's shock absorbers. Instead, their inventories of treasuries fell by tens of billions of dollars. It wasn't because no one wanted to buy. It was because the dealers' own balance sheets were so constrained they couldn't handle the flow. It is like a highway patrol car getting stuck in the very traffic jam it is supposed to clear. This is the first sign of what we call thinning liquidity. At the same time, hedge funds were unwinding massive bets, some as large as $650 billion globally. These trades relied on cheap, easy borrowing in the repo market, where you lend out a treasury overnight in exchange for cash. When their funding terms tightened even slightly, these leverage positions fell apart like a house of cards. The system's ability to support leverage was vanishing long before prices started to crash. The damage was happening beneath the surface. Now, let's get even more specific. Not all treasuries are created equal. Sometimes, one specific bond, say, the 10-year Treasury note due in February 2031, becomes incredibly sought after. Maybe it's needed to settle a futures contract or for regulatory reasons. This bond becomes special. In the repo market, people become so desperate to borrow this specific bond that they're willing to accept a negative interest rate. In 2021, the repo rate for that 10-year note plunged to as low as negative 2.5%. Think about that. You were paying someone to let you borrow their bond. The bond was literally more valuable than cash. This isn't a sign that there's a shortage of all treasuries. It's a sign of scarcity for one particular link in a very long chain. This is where it gets dangerous. The financial system reuses collateral over and over again in what's called a rehypothecation chain. One bond can be used to back dozens of different trades. But if the original owner of that special bond decides not to lend it out, the entire chain freezes. The fracture doesn't care about market segments. It spreads through the network, thinning liquidity everywhere. You might be thinking, doesn't the Federal Reserve have tools for this? Yes, in 2021, they introduced the Standing Repo Facility, or SRF. It's supposed to be a backstop, offering cash against treasuries at a fixed rate to prevent repo rates from spiraling out of control. But here's the catch. The SRF can only lend you cash if you already have the collateral. It can't create the synthetic collateral that disappears when reuse chains break. It's like having a gas station that's always open, but it can't help you if your car's engine has been removed. That's why the SRF has seen very little use, even in stressful times. It stabilizes the price of funding, but it doesn't fix the broken plumbing. Another layer of this problem comes from the futures market. Hedge funds love to play a game called the basis trade. They buy a treasury bond in the cash market and sell a treasury future, capturing a tiny price difference. It's a low-risk, high-volume strategy that relies entirely on cheap repo financing. At one point, these trades made up 60% of all positions in certain treasury futures. But when repo funding gets even a little bit tighter, these trades evaporate. An enormous layer of demand for treasuries just vanishes, making both cash and futures markets behave erratically. The market's depth isn't about how many treasuries exist. It's about how many can be financed. But perhaps the most dangerous source of thinning is what I call the invisible fracture, regulatory fragmentation. Think about it. A U.S. broker-dealer, a European bank, an Asian insurer, and a sovereign wealth fund all operate under different rules. They have different capital requirements, different risk appetites, and different ideas of what counts as good collateral. When stress hits, they don't all react in the same way. The dealer in London might stop reusing collateral while the one in New York keeps going. A Japanese bank might hoard its dollar collateral to meet its own liquidity rules. A sovereign fund might stop lending its treasuries altogether. None of these individual decisions are public. There are no headlines, no warning bells. But together, they create an asynchronous collapse. Liquidity drains from the system not all at once, but in dozens of unconnected, invisible ways. This is what makes the whole thing so insidious. The thinning shows up first as an internal adjustment, not an external shock. It's governed by willingness, the willingness of a bank to use its balance sheet to move a treasury through the system. And that willingness is shaped by 1,000 tiny factors hidden from public view. Capital charges, intraday liquidity risks, credit limits, and the simple calculation of whether a trade is worth the balance sheet space it consumes. If a bank can only earn a few basis points for facilitating a repo trade, but it eats up precious leverage capacity, they might just say no. Multiply that hesitation across the entire global financial system, and you get an ecosystem that is slowly, quietly shifting toward caution. Repo desks get stricter. Securities lending becomes less available. The market still looks liquid on the surface, but its foundations are being hollowed out. Then, when a real shock finally arrives, everyone discovers that the deep pool of liquidity they thought was there was just a mirage. Even the very process of settling trades contributes to this problem. A huge chunk of the Treasury market is cleared through a central body called FICC, which is great for managing risk. But over $1 trillion a day in repo trades happen bilaterally outside of this system. These are custom deals between two parties, each with its own rules and protocols. When stress rises, these are the first channels to freeze up. A single settlement delay, even just for a few minutes, can cause a dealer to pull a specific bond from the lending market, breaking a collateral chain. We're also seeing a rise in what's called sponsored repo. This is where big players like hedge funds get access to central clearing through a sponsoring bank. It sounds safer, but it creates a new bottleneck. The sponsor dealer controls everything: the collateral, the funding terms, the permission to reuse. If just a handful of these major sponsors decide to tighten their risk controls at the same time, entire leverage strategies can become instantly unstable. This shows just how concentrated the market's true liquidity has become. It's flowing through a few very narrow channels. Then there's quantitative tightening, or QT. When the Fed was doing QE, it was buying up treasuries, flooding the system with cash. QT is the reverse. The Fed lets treasuries roll off its balance sheet, releasing them back into the market and draining cash. You'd think more treasuries in the market would mean more collateral, right? Not exactly. As cash reserves in the banking system fall, banks become more nervous about their own funding and less willing to engage in collateral-heavy trading. And the treasuries released by the Fed often end up with investors who just hold them rather than putting them into the reuse ecosystem. So paradoxically, the total amount of collateral goes up, but the amount of reusable collateral shrinks. So what does this all look like in the real world? It looks like the increasing frequency of flash events where Treasury market depth collapses by over 50% in a few hours. This isn't because traders are on vacation. It's because the marginal balance sheet, the one that would normally step in to provide liquidity, is gone. The dealer who would have provided a quote no longer has the appetite. The repo market doesn't scream with high rates. It whispers with tighter terms and a reluctance to roll over funding. All of these factors, specialness, futures unwinds, regulatory fragmentation, settlement friction, and QT are tied together by one simple truth. The stability of our financial system depends on a delicate balance between collateral supply, balance sheet capacity, and market incentives. When those incentives shift, even a little, the equilibrium breaks. The system doesn't shatter with a loud bang. It retreats quietly. Collateral chains shorten. Dealers pull back. And by the time the rest of the world sees volatility, the structure has already been compromised. Thinning isn't the warning sign of stress. Thinning asterisk is asterisk the stress. It is the system telling us that its architecture is no longer expanding, it's defending itself. The most dangerous truth about thinning repo liquidity isn't that it signals a crisis is coming. It's that it exposes the system's deepest, most fundamental vulnerability, its complete dependence on the illusion that collateral will always flow, always be available, and always behave exactly as it should. But here's the secret. Collateral has no obligation to behave. It doesn't follow the narratives you hear on TV or in policy briefings. It moves based on incentives, constraints, and pressures that are almost invisible to the outside world. The thinning you see in the quiet hours of the market, the slight hesitations, the reduced rolls, the selective lending, the subtle tightening of balance sheets, this isn't just noise. This is the system whispering that it's already past its equilibrium point. It's revealing a critical truth long before the markets actually break. The architecture itself begins to defend itself. It withdraws flexibility, it reduces options, and it pulls liquidity out of the very channels that rely on it the most. And once this self-preservation process begins, it is nearly impossible to reverse without a massive structural shock or a central bank intervention, so large that it completely resets the entire incentive map for every player in the game. The warning that almost no one believes is that thinning repo liquidity is not a sign of fear spreading through the market. It's a sign of exhaustion. It's the exhaustion of balance sheet capacity, the exhaustion of collateral elasticity, and the exhaustion of the system's ability to stretch its own plumbing to meet a demand that is growing much faster than its underlying infrastructure. If you can grasp this one concept, you'll understand why major financial crises never seem sudden to those who are watching the undercurrents. They know that by the time volatility finally erupts and hits the headlines, the real collapse has already happened, silently and invisibly, deep within the system's plumbing. The thinning is the initial hairline fracture. It's that first quiet moment when the strongest, most liquid market in the world, U.S. Treasuries, begins to whisper that leverage has been extended too far. that the reuse of collateral has become too dense, and that the balance sheets of major dealers have grown too unwilling to carry the massive load they once shouldered without a second thought. This is precisely why every major liquidity event of the past 2 decades, from the global financial crisis in 2008 to the repo spike in 2019 to the market seizure in 2020, followed the exact same template. First came the thinning, then came the frantic scramble for cash and collateral, and then came the break. And although regulators and central banks introduce new facilities, new buffers, and new frameworks designed to contain future stress, none of these measures fundamentally alter the core truth. The entire global financial system depends on intricate collateral chains that no single entity fully maps and no one fully controls. When those chains begin to shorten, everything else follows. So, the real question we should be asking about the future is whether another episode of thinning will occur as practically a certainty. The real question is, what will the system look like when it does? Let's look at the current landscape. Treasury issuance is soaring to fund government spending. Dealer balance sheets are constrained by post-2008 regulations. Hedge fund leverage is larger than ever before. Major foreign holders of treasuries are shifting their behavior and their holdings. Money market funds, once a key source of private funding, now park hundreds of billions of dollars directly at the Fed every single night. And all the while, the silent, unmeasured dependency on collateral reuse grows with every passing year. These are not the ingredients of stability. Far from it. They are the ingredients of a structure that becomes more brittle even as it grows larger and more complex. The great irony is that the market continues to obsess over things like interest rates, Fed meetings, recession probabilities, and the latest inflation prints. These are the loud signals, the ones everyone talks about. Meanwhile, the only signal that truly matters, the one that decides the fate of the system, remains buried deep in the plumbing, visible only to those who know how to watch the thinning happen in real time. Think of it this way: everything you see on the surface reacts, but everything that happens below the surface decides. The surface is the effect. The plumbing is the cause. So if there is just one thing to take away from this journey into the hidden architecture of finance, let it be this: the system never fails when it looks weak. It fails when it looks completely normal. It fails when the charts are calm, when credit spreads are orderly, when market depth appears adequate, and when all the participants believe they still have time to react. Because by the time conditions finally look unstable, the damage is already done. The game is already over. The repo market isn't a mirror reflecting a present crisis. It's a telescope into the future of the financial system. And the thinning of its liquidity is the very first glimpse of what that future holds. The warnings are always there for anyone willing to look. They just never, ever speak loudly.